Ladies and gentlemen, dear students, it's a great pleasure for me to welcome you today for an economic IDS interdisciplinary seminar in the form of a public lecture here at the DA. Just for your information, this talk will be live streamed and also recorded and put on our webpage. I would in particular like to say a warm welcome to our speaker, Dr. Ingo Sauer, who is an economist lecturing at the Goethe University in Frankfurt. Dr. Sauer has dedicated his research to central banking, inflation, and more generally monetary policy in the euro area. I would say he's a very modern economist because he's very active on social media. That's also how I got to know him and about his work. He has an own YouTube channel on economics. I hope that you have a very good education in economics at the DA, but in case something is unclear, I highly recommend watching these YouTube videos. And he is also featured as an expert on hyperinflation in various prominent podcasts. So Ingo is going to present his current research entitled The Lessons from 1923 for the Euro Area, Enlightening the Dark Side of Insolvent Central Banks' Balance Sheet. And the talk basically features two elements. It's going to have an historical analysis. We're going to see what happened in the 1920s, where certain countries in Europe experienced hyperinflation. And of course, we'll learn about how this inflation actually gets out of control. So what are the drivers behind hyperinflation? About housekeeping, I would say we have to talk for 60 minutes. Followed by a Q&A session. So with that said, I would hand the floor over to you. Ingo?
Okay, thank you very much. Thanks for having me. I'm not very active at social media at all. Not at all. There's just a channel called in German Wissen hat keinen Eigentümer. And I'm proud of that name, but it's only filmed lectures, and I don't have even Instagram and all of that. So, sorry, I'm a pure consumer of Twitter, for example, not very active in all that social media context, but the channel is very popular among German students or German-speaking students, and they use it as a nice reference to study micro and macroeconomics. Okay, well, thanks for having me, and it's a great honor to speak here, or let's say it's a great chance, an opportunity, to bring this message I'm going to talk about to the new global leaders. I know that many of you are going to become global leaders. I know it from your university's website, which I checked after the invitation. And seriously, like this school produced a lot of outstanding diplomats, and you are exactly the audience I want to present, like this research or this message about central banking inflation. And I really think that this issue, the euro being a soft or a hard currency, is going to be like the main question also for the European Union itself. Yeah, and I think we have to understand a bit better what is going on here in the euro area. And well, the research is historical. The eye-opening part, I'm going to speak about the great inflations of the interwar period, the four famous ones, like here in Austria, in Germany, in Poland, and in Hungary. Okay. So let me begin by the take-home messages. The Bundesbank, or all of these national central banks, Banca d'Italia, the Austrian central bank, and all of them, I just want to make you aware that it's a rather decentralized system. And as we know from history, many currency unions also fall apart. So each of these national central banks, and if we stay together, like the whole euro system, they can become insolvent. And in economics, that is my research, or that is my statement. We don't really understand the insolvency of central banks because we overlooked them. Yeah, and I come back to the hyperinflations of the 1920s, like the most important inflations which dominate that chapter about the strong or hyperinflations in our textbooks. We misinterpreted them. We overlooked like these central bank insolvencies, and therefore we don't really understand them. But we have to, in order to prevent like this scenario from happening in, for example, here in the euro area. So they're best characterized, all of these hyperinflations of the interwar period, by central bank insolvencies. And these insolvency-driven inflations, they have like different dynamics. Yeah, they have different tipping points. They have different reinforcing effects, and therefore it's very dangerous not to go to that blind alley without knowing how they really work, right? They're different political constraints. They're different tipping points than with the usual framework we use. Okay. In each case, they could be stopped only through the banks or the central bank's recapitalization, which we also overlooked. And this recapitalization is particularly difficult because the government has to raise capital in advance of all these fiscal efforts, right? It has to raise capital, still lacking access to domestic or international funding markets. And in these 4 cases, capital has been raised quite differently, and obviously we can learn from these historical events. Yeah, but just like we have to think about how to recapitalize our central banks, which can become necessary in the near future. So what blinded us from all of these, which like behind the scenes, the central bank actually became insolvent, and therefore we had this hyperinflation. And what blinded us from realizing that these inflations could only be stopped by recapitalizations was like a very, let's say, an oversimplified theory called the quantity theory of money, because at the same time, and that's true, like the money supply also increased, and we did not notice that this was more like an accompanying symptom or a concomitant of central bank insolvencies. It's like not exactly the same. It's like only really an accompanying symptom, and therefore we did not notice what was really going on, which took place at the other side. Remember the paper's title, or my speak's title. It's like the other side, the dark side, the asset side of the central bank's balance sheet. What really matters happened there, not the money supply. Okay. And I will justify, obviously, that claim. And again, without understanding these mechanics, we cannot prevent that situation. We cannot fight off. We cannot manage, and we cannot plan like the necessary recapitalizations, which might become necessary for the Eurosystem central banks or for the complete Eurosystem. Okay. So this is my paper I'm promoting, and it became longer. And well, I'm not active at social media, but I had this channel, and also I was invited by some more popular people, like this podcast in Germany twice from Daniel Stelter, which is the main or the most important economic podcast in Germany, and it was reflected in Handelsblatt, and also I gave interviews to other YouTubers, actually a professor from the University of Applied Science in Frankfurt. And therefore, like, it reached hundreds of thousands of listeners. One was your professor, therefore this invitation. And as I heard, many of you also, or some of you, sorry, also had a look at this paper. And it became more detailed all the time, yeah? Not only longer in a sense, but also detailed. And the reason I also not for the usual submitting process. There you cannot enter or submit a book-sized paper, but in order to capture it all, right? The data, then the econometric evaluation, then the historic evaluation of that econometrics, if the numbers which show up are also backed by what politicians or policymakers had to say, and like each number has a decision in the back, let's say, and also like a theoretical reasoning. So I cannot just claim, well, we overlooked in our textbooks these the real reason for those inflations without like presenting it all, and then also applying it for the euro system. That makes it very long, and I get more and more comments, and it's a very detailed work. It's really completely detailed. And for the econometric part, and also for the historical part, for the historical confirmation of these econometric part, and I also spent a lot of time in explaining in the history of economic thought how that argument in the back like disappeared and appeared. Like my argument in the back is money has to be backed by valuable assets, yeah, which back in the days was called the Law of Reflux, and it's a very detailed work. We don't have time, and luckily for you, we don't go into the details. It's just not possible. We do the complete opposite, and I will give you a very simplified, metaphorical version in order to get the big picture and to cover the main ideas. Yeah, the main concepts without all the details, and that's going to be, well, the current debate, which that's my main point or my main statement. It's kind of misleading. We have to understand what is really going on behind the scenes, and there are comments about the balance sheet of the ECB or these national central banks, but as we will see, for example, when it comes to the target balances, they're not very concerning, they're not very detailed, and they're completely misleading if my theory is kind of true. Then we're going to talk about this dark or the hidden side of the balance sheet historically, and as we will see, it was like overlooked in our economic textbooks, which comes from that oversimplifying idea, the quantity theory of money, which actually is a very natural view for economists, and it fits also at first glance, it fits the data, and it's like our leading concept for the strong inflations, and therefore like we overlooked what was really going on. And then we're going to shed some light on this inflationary path, like on the dark side of the central bank's balance sheet. And finally, I'm going to show you that this hidden variable bias and also the econometric evaluation, as I said, we don't go into details, but let me tell you that I did that work. I just want to mention it. It's kind of a very scientific approach here. And then we talk about the euro. I'm going to apply it to the euro system. And the euro system, as you may know, they have also kind of some centrifugal forces, like it could fall apart, and that has to do a lot also with like the asset side of these balance sheets from all these national central banks in the euro area. Okay, let's start. So the current debate, I have to like simplify even further, and let's get like only the main arguments. So after 2008, the main concern is, well, the money supply increased, and it increased relative to GDP until now more or less by a factor of 6 or 7. And now if we have some knock-on effect, all that money is not immediately causing inflation. Everybody knows that, yeah? Nobody was concerned that, that money immediately will one-to-one cause inflation. We don't believe in that quantity theory of money in a strict sense, but obviously that money, once it is created, it's somewhere in some liquidity hoards, and if some knock-on effect, which happened in the last year, happens, then it's going to be inflationary. Right? So let's look at these knock-on effects which we had. So we had this supply shortages, first pandemic-related supply chain problems, and now because of the war. And yeah, for sure, that's the reason for higher prices. Yeah, less supply, and also the demand, which we could not during the pandemic, now comes again. People go to the restaurant, and therefore, obviously, we do have inflation for simply the supply shortages. They can happen as they do right now, for example, with the Russian gas outside the country. So we have this increased resource prices, but actually there are supply shortages. And then, in the second round, we can have this increased wage demands by labor unions, or the wage price spiral we are talking about all the time. That causes inflation, and we can have exaggerated fiscal stimulus or transfer payments by the government, which at the end will lead to higher demand, either the government itself or us, because of these transfer payments. And with the same supply, there's just inflation, right? But all of these reasons, it's only at markets, labor markets and goods markets, it's only where money is used. I'm going to tell you a different story, not where money is used, less supply, more demand causes inflation. No, I'm going to tell you a story about money itself loses its value. It's not on markets where money is used. No, money itself is debased. The institution behind that money becomes insolvent. The money itself, the problem is in money itself, the debasement of money itself. Well, and I think we cannot understand the risk of really high inflations if we look at the use of money. But in the textbooks, increase of the money supply, and then via its demand on goods markets, turned out to be inflationary. And I tell you, it's not the case. For all that great inflations, at least the 4 ones I studied, I can really show it to you, it was not money, its effect on goods market causing that inflation. It was really money being debased because the central bank became insolvent. It was attacked on foreign exchange markets at first. Nobody accepted that money. Trust was lost, but trust has a category. It has numbers, right? Which is the central bank's balance sheet, which is the assets of that. We can measure the lost trust, yeah? Behind these lost trust is central bank losses. And this trust can be restored in a matter of weeks, as it happened with all these recapitalizations. I will show you the German case, but by raising capital. And if nobody wants to pay in, we have to force them to pay in, like it was done in Germany, right? With a huge forced mortgage. And all that knowledge is kind of lost because economists later agreed on that, it happened on markets. No, it did not happen on markets where money is used. Money itself was debased, or the institution behind. And to make it that idea is the main one, and it's very important. It's an old idea, actually. It was mainstream economics in the mid and late 19th century. Back then, economists agreed on that idea that money, first of all, in order to be stable, has to be backed by valuable assets, or like they called it back in the days, this law of reflux. The central bank can never ever lose control over its money supply. It has to be in control over its money supply by issuing only for very secure repayment obligations. And let's do, metaphorically, bring this repayment obligation, like this backing of money, to our mind. So mostly we think about all these bills, like being, or notes being accepted. We think about them as, well, anybody accepts it. Yeah, so I just use it, we get paid, and then I buy, and we never really have to think about why it is accepted. And obviously, part of it, it's because the power of law, it's a legal tender. The government tells us, well, you can pay your taxes only in that money, not in different forms of money. And obviously, our intuition tells us, well, it has to do something with scarcity, yeah? If it was there in abundance, then it's not as valuable, right? And I'm telling you, it's not really scarcity, because it's scarcity compared to the assets or the repayment obligations which back up that note. And let's do that example right now. So we use it all the time. Also, like, intuitively, we look at these markets where it's used, and then demand, supply, if something happens. No, but let's see, like, the institutional side. Though this guy, he, let's say, takes out a loan from the central bank, and at the same time he agrees on a repayment obligation. Yeah, I'm not going to show you, which I do in my lectures all the time, like now the intermediary banking system and the yield transformation, because there are additional liquidity risk and solvency risk and equity, which is regulated like a buffer for all that solvency risks. But let's simplify further. So just like he signs the repayment obligation, yeah, I'm going to pay back in 3 months from now. And obviously, this institutional side of money, let's call it, has an effect, and we are confused about, we don't really anymore, yeah, back in the days they did, but we don't really talk about this repayment obligation that much, because like money itself is transferred. It's not only credit, it's like an IOU. All banking is an exchange of IOUs, yeah, and this money itself is an IOU. But it has a twin, the repayment obligation, which stays in the books of the central bank. And confusingly, it's a transferable IOU. Yeah? Like, it's transferable credit, and another businessman, in this case, this bookseller lady, she pays it back to the central bank. Okay? But she also took out a credit before, and her bill also had a due date on it, let's say, metaphorical terms. Like, all bills do have a due date on it. They are born together with a repayment obligation. This repayment obligation stays at the central bank. Yeah. In this case of the 1920s, we don't see it. It's like invisible. It's only in dusty books in historical archives. But the repayment obligation exists, and therefore money does have a value for the complete system. It's tied to, it's hardwired, it's tied to these repayment obligations, and at the end, all of us, yeah, together in aggregate, we needed to pay our debt. Okay? That's the main argument. It has an institutional side. Other arguments are true as well. It's a legal tender, power of law, but mostly it's valued because it has an institutional side. It's backed by the assets of the central bank, which are easiest to understand if we think about a repayment obligation being born like a twin at the same time together with that note, right? It's a swap of IOUs. What happens if, and the question is, what happens if these payment obligations default and money is, like, the central bank loses control to redeem that money, and then it comes to what I'm going to talk about, pressure on foreign exchange markets, and finally price increases inside the country, the central bank is vulnerable. It's financially vulnerable. Okay, again, so we look too much at these markets, what's going on in the markets where money is used, and all of that is correct. Yeah, there's inflation, let's say up to 15-20%. So all of that obviously can cause inflation, and it's very serious. Also, inflation of 15 or 20% or 10, let's say. But the real strong inflations above 30%, yeah, and this obviously is happening in stages. But the more concerning one has to do with like these wires not being in place anymore. Yeah, it can be that the central bank suffers losses. It can be that it does monetary financing to finance its government. And it's not, the problem is not that the government spends all that money on these markets. The main problem is the central bank becomes financially vulnerable on foreign exchange markets. And we have to look at the central bank itself, on the institution, to understand the force of these insolvency-driven, these exchange rate-driven inflations. That's going to be the line of argumentation. And we don't look, all of it, it's like I put unperceived, but it's invisible, sorry, right? So it's written down in some bookkeeping entry, yeah? In this case, for the 20s, in these dusty books in historical archives, not well documented. It was a lot of work to get the real numbers for these repayment obligations. And if they default, the central bank is in trouble. That's the story. So economists, and bring that back to mind, we care a lot about the money supply, which is easy to measure. We don't care that much about the institutional side of money because it's very difficult to measure. These are very different types of assets. And so we didn't really observe them. For example, until 2011, before we realized, oh my goodness, there are huge debt between the national central banks of the euro area, called the target balances, right? When these sums build up between 2007 and end of 2010, nobody published about that. Everybody publishing about that topic, understanding that it's real credit between the national central bank, would be famous today. Nobody did. And when Hans-Werner Sinn, like when he realized at the beginning of 2011, that number is a number of concern, it's a problem for the Bundesbank if the euro falls apart and so forth. It was 45% of the balance sheet total from the Bundesbank. 45% of the balance sheet total. Why nobody published about that being famous today? Because economists look at the money supply and not that much on the assets of the central bank. It's not only true for the inflations of the 1920s, it was also true for like the last decades, and now more and more, I feel that, because people like write me comments, a lot of academics as well, professors, because now we're looking more and more to the balance sheet, and that has to do also with these target imbalances or target balances. Let me come back to the main point. So every note circulating around is actually tied, right? It has to be paid back to the central bank, and probably it's not a real repayment obligation, could be gold or other equity-like assets, but no matter, it's tied, and the central bank has control over that money supply. It can easily redeem this. Until it has the assets, it's financially sound, it can redeem the money supply. And we cannot have strong inflation. We can have a little bit of inflation because of all of these supply and demand reasons we talked about before, but the really concerning inflation, which has other reinforcing effects, right, and other tipping points and political constraints, is not a matter. So the main work The main task for the euro area is to secure these assets no matter the costs. It's very important. We have to do it. Okay, again, let me make it even more metaphorical here. It's like the main point. I really have to emphasize it again and again and again. This note, yeah, it's not like pure social convention or trust or so whatsoever, which makes it a hard and accepted currency. No, it's debt or it's obligations. Yeah, repayment obligations to be more precise, or enforceable repayment obligations to be even more precise, right? If they're not enforceable, they're not worth anything. So they have to be backed, commercial bills, like back in the days, 3 signatures. Yeah, everybody's liable. Yeah, the central bank can seize their property. Advances on collateral, right? It's an enforceable, a very secure repayment obligation, and there is collateral on it, right? Gold or foreign exchange, as I mentioned, you probably also have some equity or some assets which are not repayment obligations itself, but we have to secure that these repayment obligations are really enforceable, and if they are not, because probably we have too many treasury bills which increase, and the government gets into solvency problems, then the money itself loses its value. And later on the markets where it's used, but these are effects, but actually money itself loses its value, and that is what happened during the hyperinflations. So we had less well-secured commercial bills. It's a very secure repayment, enforceable repayment obligation. We had less advances on collateral, less gold. The Reichsbank, for example, lost almost its complete gold holdings, twice. It lost half of its gold holdings from one day to the next. So, and therefore, we had inflation or additional inflation, but it was also about these treasury bills. Like at first, it's not you give credit to the government and immediately you have inflation. Obviously not. At the very beginning, like all European countries, they had this war finance. In order to raise capital quickly, it always works via the central bank. You cannot even issue that many war bonds in a matter of weeks. And at first, it doesn't cause inflation, because there are not too many, and also like the government still is kind of solvent, and they tell it, we pay back until after we won the war, And if in the process of that not turning out, it became a problem, and it happened in stages, and money lost its value, trust, let's say, but money itself was debased. Okay, now, just to make you remember, let's talk about this target claim from the Bundesbank. It's still, I chose a year where it was still 45% of its balance sheet, and now it's a matter of concern, but the debate, and I think that's a huge problem, so it was like dark until 2011, now it's very obvious to everybody, and if the euro falls apart, the Bundesbank loses like 3 times its annual federal budget, but these are actually the popular evaluations of that risks. Like a sizable part of our economists say, well, it doesn't really matter. Doesn't matter. You don't need assets to back up a currency. And also in our textbooks, that's the main story. Assets are not necessary for a sound currency. And you also have like here, and this is still was what Hans-Werner Sinn, like the figurehead or like the one who discovered this target imbalances or discovered their credit nature, here says like, okay, it's a real loss, but it's not a matter of concern. immediately. We don't have to recapitalize the Bundesbank immediately. And I tell you, there are no plans, yeah, at least to my knowledge. If the euro falls apart, well, in Austria it's not a big problem because you don't have these claims, don't have this problem, but Germany, if my research is correct, in a matter of weeks or days, we have to recapitalize the Bundesbank, or the new German mark is not going to be as stable or as much worse as the Austrian shilling. Yeah, we have to raise hundreds of billions of capital, not the complete sum, obviously, but a sizable part, probably, and not because the target debtor countries, they don't want to pay, probably they cannot. Yeah, it's going to happen in a situation when they just cannot compensate us. In the short run, we pay later with low interest, and there will be some arrangement, but we have to plan this recapitalization, if my research is correct. And you don't hear that statement a lot. Yeah? You don't hear it. And I think it has to do with us not understanding really that all these big inflations actually have been central bank insolvencies, and the Reichsbank had these central bank losses, which caused inflation. Okay. Sorry for getting kind of emotional. Okay, so where do these strong beliefs come from? Again, like it's this quantity theory view, which is very natural view for economists, and it fits actually the data. And if we don't look at this booking entries, like this asset side of the central bank, and we only look at markets, we developed the following theory, right? If you, also the more specialized textbooks, if you check them, for strong inflations, yeah, textbooks about the exchange rate determination, you will find the monetary model of exchange rate determination, which is like an expansion of that idea of the quantity theory of money, and it's completely logical. Like probably not for the, it's not a one-to-one relationship, but for the very strong inflations. We obviously, yes, more money, which creates more demand on these good markets, and it intuitively stands to reason, like scarcity gives goods value, right? And also money should be scarce somehow. It's like the most, it's like all our microeconomic concept in a sense. So if you have more money, well, via this demand on goods market, the price level should increase, yeah? At least for the very strong inflations. And then, in a second step, we said, well, there is something like the law of one price, and if we define it broadly, we can call it PPP, or purchasing power parity. Then, in a second step, right, because the country loses competitiveness, in a second step, money is worth less domestically. Yeah, I can buy less, the price level increased, and that should mean that it's also worth less in foreign countries. I don't can buy with my euros as much goods in foreign countries, right? And now, let's stay with the first part. It's a very natural view because, well, I already mentioned that, like we talk about the relative prices, and money should be neutral, which is also very old, like paradigm, and the scarcity of money should be like somehow guarantee its value. And it's also a logical order because first of all, something happens domestically, and then in the next chapter, right? Like the closed economy, and then in the next chapter, the open economy. Yeah, also makes sense. And I'm going to argue, obviously, that it's the other way around, at least for these high inflations. It was the central bank, well, let's do it on the next slide. So this theory over here is kind of misleading. And I show you the most obvious case, which is the German hyperinflation. As you can see, we do have, first of all, a logarithmic scale, but also it's indexed here at the war's end before the German mark lost a lot of its external value compared to the dollar, and before we had a strong inflation in Germany. So it's indexed here in November 1918 to 1, and then we see like the relative percentage increases, and this is only the price level and the money supply. And it looks like, well, times a billion price level. Well, there should be this this relation. More money on these domestic markets, price level increases, and therefore you have an equilibrium again. So now I add over here, I give you the complete logic again. So more money, more demand on goods markets, price level increases, and via purchasing power theory, we have the collapse of the exchange rate, and we have fancy equations, which you find in the textbooks, and here are beta actually is a semi-elasticity, and alpha is an elasticity. So there is some interest involved and some real growth, but generally it's about the amount of money relative in two countries and the price levels which define the exchange rate, right? So that's the logical and more intuitive explanation for us, for the strong inflations. And if you check the textbooks, they say, oh yeah, for the strong inflations, we really see that relationship, and it's empirically proven. Well, now I'm going to argue that this is misleading, as you can imagine, as I did already all the time. And to show you this, I'm going back to that it's exactly the same graph. And only for Germany it is that obvious, because in all other countries it more or less all these three variables changed at the same time, but not in Germany. And I'm going to index it again to the war's end, November 1918, and now you have the money supply, the price level, and the exchange rate. And as you see over here, like the first wave of inflation, the heavy inflation which set in a year after the war, peaking in February 1920, the collapse of the exchange was 90%. Compared to the war's end, the mark was worse only 10%. Yeah, by a factor of 10, it collapsed in a few years. And the price level increased by a similar number, yeah, not as much, kind of makes sense, right? Tradable, non-tradable goods, and so forth. But by similar numbers, it increased by a factor of over 7. The money supply did not. What happened? And therefore, I emphasized it so much. One of these ropes, yeah, an incredible, huge rope, one of these red ropes or wires, yeah, which connects the money supply, which gives the central bank control over its money supply, disappeared. It just disappeared. The Reichsbank lost half of its gold holdings. And coming from a gold standard, you can imagine that we had a lot of gold, which actually increased during the war. So it just lost a certain huge percent of it, all its assets, the most important ones actually, and therefore the central bank has been vulnerable, which you can prove if you go like the time series which I developed in a model, which shows the solvency or the insolvency of the central bank, which shows which exchange rate it approximately, given its financial situation, can defend. This one increased first because of these gold losses, and then the real exchange rate increased, and then also the price level increased, but it wasn't the money supply itself, it was central bank losses. And many times it's the same thing because, well, this one I don't have time, I'm going to talk about later probably, but here they fixed the exchange rate, sacrificing another time half of its gold holdings, like it was, everybody understood, like I really went to the, there was an inquiry like where they asked the president of the Reichsbank, did you really believe that could work? No, obviously not. We knew that we are going to lose the rest of our gold, let's say. Without a long run effect, we can stabilize the mark probably for a few months only, but the government wanted me to do so. It had to do with the occupation of the Ruhr area and the passive resistance, but in order to stabilize prices. So back then, they already understood we can stabilize the price level if we stabilize the mark to the dollar, but it's not, we can do it only for a few months, right? And then you had the absolute catastrophe afterwards because the Reichsbank already lost almost all its international reserve gold at the time. Okay, well, so you see, it's not, let's stay with that one, it was central bank losses. But many times central bank losses are the same thing as money supply increases because you give money to a broken government. There is no rope. This money is not coming back ever. Yeah? And therefore, let's enlighten now this dark side of the central bank balance sheet or the inflationary path via the central bank's balance sheet. So let's say inflationary financing, but of a completely bankrupt government. The government is already insolvent. Argentina, right? That monetary financing, yeah? Not what we do right now, completely different. That type of monetary financing probably causes, like this is the textbook example, demand on goods markets, the government spends money, yes, for sure, there should be some effect, but now, at the end we see like these three variables, they move together. Money supply increases, yeah, 10 times more money supply, price level increases, let's say by a factor of 10, and the exchange rate increases, like normal times, not additional central bank losses, normal monetary financing, a broken government. So we are in Argentina right now, or in all other hyperinflation countries, like it was that mechanism or that relation, all variables more or less by the same amount all over the time. And now let's go here and ask, well, there was the backing of money, the debasement of money, the institutional coverage of money. Does the central bank have control over its money supply or not? And what actually happened also by monetary financing a broken government, it's not only that they spend more money on these markets. Yeah, you're not only influencing supply and demand on markets, you're influencing also the solvency or the financial situation of that central bank, because it's thin air which you book in. Yeah. So probably by financing a broken government, it's not only the effect on goods markets itself. The effect here is the central bank becomes insolvent, it's vulnerable on foreign exchange markets, and now, probably this effect is not as important, and now, well, vulnerable on foreign exchange market, its solvency deteriorated, it gets under pressure, the exchange rate collapses, and then the price level increases. And if you have a time series for the solvency of the central bank, which I developed, you can check which order of action for all the 4 time series, central bank, solvency, money supply, price level, and exchange rate, which fits better, which theory fits better, order of action, their interaction, and it's clearly for all countries this theory than the other. Than the common theory of like money supply via goods markets, price level, and so forth. But then we have to check this institution. And there is a lot about to learn. Like I told you, I did it, like all of these are numbers, and they have like also the recapitalization later, but also during the hyperinflations, there are decisions over here going on. Yeah, there are different stages. Yeah, and from time to time, also in Germany, when you remember this graph over here, there have been reforms in the back Here it got better, much better. The exchange rate came down, yeah? The mark gained 100% against the dollar. And what happened? We had huge financial reforms going on in the back. So, and these again show up at the asset side of the central bank. Well, okay, that's the main story. And obviously, now, as you probably studied some economics, let me make 1 or 2 points why this actually also fits better what we observe for the strong or hyperinflations. And check out the third point over here, like strongly preferred. Let's say the central bank loses control, right? It doesn't have any assets. And we say trust is lost. Oh, sorry. Trust is lost. And it loses control over there, yeah? But trust has a category, it's the solvency of the central bank, and there are numbers to prove it. But let's say trust is gone, yeah? You don't believe in that, you just want to get rid of that euro bill. Just want to get rid of. Where do you go? You buy consumption goods? Probably consumption goods, durable like a bicycle or a car. Yeah, maybe. But what do you actually want? You want something equivalent to money. Yeah? The closest substitute. Doesn't mean that you want to spend immediately. The amount you want to spend, you spend it on consumption goods. But the rest of it, where do you go? To exchange it into something else, gold, other assets. No, you want the most equivalent asset, or the closest substitute, which is other money, foreign exchange, right? And that happens, a few months ago, a friend of mine is a chief economist of the central bank in Argentina, actually. And he did the PhD with me in Germany. And I know Argentina quite well. I've been there several years. So that's also why it's there you can really... And I hold a speech with all the directors a few months ago at the central bank, kind of a research stay. And obviously, they immediately understand what I mean. I don't even have to show this graph. Because if you go to the main shopping street, Florida, it's like on every corner they tell you, hey, you want to change euros, dollars, whatever? Yeah? And everybody just change. No, the peso, you use pesos, but it's just like you have to use it. You're paid in pesos and you buy in pesos. But the real unit of account is the dollar. And you cannot ban dollars. It's much easier to ban gold, obviously, because it's not necessary. But the foreign currency is necessary for international trade, and you only can regulate it. In a note from my friends who work in companies, who have to import and do exports, it's all regulated, as it was in the 1920s over here, but that regulation obviously fails because there's always an advantage also for the commissioners who have to observe or to control, to supervise all that regulation. And therefore, should I tell you the real story? I came to the central bank and I didn't change any money. Like I went immediately I had some pesos left actually, which lost a lot of value. So from the hostel, I went directly in the morning to the central bank. And obviously I came with euros in order to change it, and it was offered to me immediately by like even the people who work in that bank. You know, it's just like everybody is used to, I want to get rid of these pesos, yeah? And I did not accept because I always apply the law, but in these countries, like, forget about it. Like there are WhatsApp groups in the hostel. You can just call somebody and he comes like to change the money with, like, let's say, to the black market rate, the one which really matters, only 10% less, and he's there in 30 minutes to change it to you. And the legal rate, like the official rate, is only half of it. Yeah, but nobody takes it serious. Like the black market rate defines the value of the money, and then it defines also goods. So it's very obvious over here that you go to this guy and strongly preferred. Yeah, so it's what if trust is lost, if the central bank is insolvent, you just want to change it. And let me emphasize also, like, putting the cart before the horse. So it's kind of counterintuitive for us, for the right-hand side, that the exchange rate, yeah, the external sector, the international, like the next chapter part, that one defines our price level. But that's really the case in hyperinflating or strong inflation countries. And it's counterintuitive, but let's think about it again. And here I put a quote from some newspaper quote of the time, which says, well, for the German mark, increasing role of foreign exchange in Germany. For example, the Daily Mail wrote, the mark is becoming the slave of the dollar. We have marks in our pockets, but dollars in our heads. That is Argentina. Yeah? You have pesos in your pockets, you pay with pesos, you're getting paid in pesos, but the prices are calculated in dollars already. Yeah? And if the dollar devalues, everybody knows, well, now my house is worth that much in pesos. I'm not going to sell it for less. Like, prices are immediately adjusted. I've been in the supermarket several times, like trying to pass that lady which puts the new price tag. And this is after the peso devalued, more or less. It's not one-to-one, but more or less. And actually, we can also explain why usually the collapse of the exchange rate runs ahead of the rise in prices, right? It's more tradable goods, but at the end it becomes also non-tradable goods. And the more you are in that inflationary spiral, the closer the relation gets. Usually it's not one-to-one. So go to Argentina whenever the exchange rate collapses, and then it's cheaper. And a few months later, prices increase by the same amount, one-to-one, but at first only 70%. So this also we can understand. And last point, sorry for being theoretical right now. This central bank insolvency, yeah, actually is a missing link between the two big traditions in monetary policy. Keynesianism, monetarism. Why? Let's think about the last 10 years in the euro area or in the US. And we had like two voices or two groups of economists. And there have been these like rather Keynesian economists, like Paul Krugman, I put here as an example, and that's a quote. He said, like, this quantity theory is just totally, utterly wrong. It's just wrong. We have seen like the money supply increases by a factor of 5, 6 relative to real GDP. Nothing happened until very recently, but nothing happened. So it's just wrong. And we had like the more Chicago school, monetarism trained economists who say, well, it's not one-to-one. Keynesians are right, it's only going to this liquidity hoards, but at one point in time it's potentially inflationary, at one point in time it's going to be, and we don't really know, yeah? And what makes these fluctuations, that at first the money supply increases, nothing happens, and later comes inflation, like that it was during the great inflations here in Europe. First war financing, first money supply increase, later built on defaultable public debt, later central bank insolvencies and inflation. So now it makes it consistent, right? So if we put this central bank insolvency, it's solvent or insolvent, in the middle, we have, like, we can close or shrink this gap between these two traditions. Yeah? Okay. At least this is like something I would recommend. Okay, so it's, and surprisingly, if I see into your eyes, many of you like follow and you believe more or less what I'm saying. But surprisingly, it's a hidden variable. It's not in the textbooks. It's not in the textbooks. And let me show you here, typical textbook. So this is Menke, 2015, and we have seen these graphs during our studies. And well, the professor also like tells you this is only for the very strong inflations, and it's in the chapter about strong inflations. Don't take this relation, this quantity theory relation between the amount of money relative to produced goods, like relative to real GDP, defining the price level, too serious. But for the strong inflations, we know it. No. The strong inflations actually, right? It happened at the same time. The central bank became insolvent because it also financed the government, but once the central bank was recapitalized, which happened in a matter of days, the money supply kept increasing strongly. It's a logarithmic scale, so you don't really see it. It kept escalating, nothing happened. No price increases. Because the central bank, after it was recapitalized, it just fixed the exchange rate to the dollar, in Hungary to the British pound sterling, and then inflation was over. But the main changes happened at the asset side of the central bank, and even more confusingly, over here, if you check the source, which I did at the beginning of my research, if you really read it, the data source for this graph, not only in Menke, in several textbooks, it's Sargent, who has very similar arguments, and which are, he realized this anomaly that the money supply kept increasing, escalating, it tripled, or it increased sixfold in one country, he realizes, after they abruptly fixed the exchange rate and thereby ended inflation. And there was no currency reform, that's also important, it's the same currency. But the central bank started to issue unbacked money. He oversees, like many others before and after, the main part, which was the central bank recapitalizations. But that is also because he depended on a vastly insufficient data set. And in his data set, he couldn't realize, like for example, in Germany, the complete treasury bills, which was like 90% of the balance sheet total, was replaced by the Rentenmark. The Rentenmark, first and foremost, was an asset, to finance the recapitalization of the Reichsbank and some bridging loan for the government. It was not we didn't have a currency reform in the sense of one currency being replaced by the other. So, and in his data set, it was missing. Or also here in Austria, like he could not see like this replacing this asset inflow, the recapitalization of the central banks, and misses that main part. But his main observation that something happened on the asset side, not on the liability side, was largely neglected by our scientific community. Most importantly by Milton Friedman in a standard setting article in the New Palgrave Dictionary of Economics via the entry quantity theory of money. And therefore we don't know it. The Sargent was not very complete, but this observation, at least that it cannot be the quantity of money, something happened at the other side, the asset side, he at least that one he realized. So now Germany, amazing. They stabilized the exchange rate 15th of November 23. And a few days later, and the guy who did it, the new president of the Reichsbank in charge, Schacht, he said, well, we had to adjust it a little bit. In order to really defend the exchange rate, we had to go from 2.5 trillion to 4.2 trillion. 4.2 trillion marks, $1. But it was 5 days later. And after that, inflation was gone. No inflation. A little bit, but no real inflation. The crisis was checked. And the money supply, same mark, exactly the same mark, increased by a factor of 15. It increased 15-fold, right? So you had 15 times as many wheelbarrows, but they maintained their value. And Sargent only noticed a tripling of the money supply because I checked here the weekly data, which was not available for him. Okay, now how is that? Why is that? What's on the other side? I show you the very beginning. So 15th of November, the red thing you see over here, they are treasury bills, completely worthless. I also developed a measure to check how much these claims against the government are worth. Yeah, like paired bond mark prices. At that point in time, Germany was completely bankrupt. Yeah, the Ruhr region, the main industrial heartland, being occupied by French and the Belgium, failing repeatedly on the reparation payments, not able to issue any loan in Germany, completely failed by issuing some kind of a dollar or a gold-denominated loan bond. No, Germany was completely bankrupt. And I have other numbers to prove that from bond market prices, traded bonds, and all these short-term bonds, the Reichsbank bought all of them, 99% of these treasury bills, with the Reichsbank not being worth anything, thin air, and they recapitalized the Reichsbank here with Rentenbank notes, the foundation of the Rentenbank. The Rentenmark was never a legal tender. It was accepted at public authorities, but it was not a legal tender. There was no currency reform. It was not one currency being replaced by the other. We stabilized the old mark. The government had to raise capital without receiving any credit. Yeah. It's still not having access to any funding markets, domestically, internationally. Yeah, here in Austria it was different. You had the help from the League of Nations and the other countries, but in Germany not. So, how to raise capital? Well, you can also raise capital by some forced mortgage, right? Investors don't believe that you can raise capital in the future by increasing your taxes and stuff. No, but you can do it immediately right now. And it was an enormous forced mortgage on all landed properties from commerce and banks and stuff. And therefore, they created an additional currency, not the legal tender, but an additional currency, which was used to pay public employees at first, but then also to recapitalize the Reichsbank. That was the main purpose, recapitalizes. And after that date, 15th of November, they decided, okay, the next note which we issue is going to be backed by the hardest asset available, which is enforceable short-term repayment obligations in this called commercial bills. Yeah, 3 signatures from entities or persons with a known solvency and short term, and this is a very, very secure repayment obligation, similar to the other advances on collateral. And, well, securities are not really, other positions did not really matter. So if you remember, and there was a speculation against the mark, because that's also an interesting part. Central banks are special. They're not like banks. They're not at all like banks, because banks have to be liquid. As it turned out, central banks, at least here in this amazing natural experiment, the Reichsbank wasn't liquid at all in dollars. It stabilized the exchange rate to the dollar without being liquid in dollars. It could, for the first month, like almost half a year, yeah, we know from Schacht, only pay out like a few % of all the allotment of dollars. Yeah, Like 1, 2, 3, 4, 5% of these applications. The people who wanted to get dollars on that fixed exchange rate for 4.2 trillion. It wasn't liquid in foreign assets, in international reserves like gold or foreign currency. It wasn't. Nevertheless, a speculation against the mark ended and came to an end, or failed already 3 weeks later. Yeah? So it's enough to be, you don't have to be liquid, it's enough to be solvent. The Reichsbank was very solvent, and that is enough. Because the speculators, they themselves, I explain it much better in the paper, but they themselves create a demand for the mark, right? If they say, I'm going to, like this forward dollar mark for a much higher exchange rate, well, few weeks later, you have to get marks to pay, but nobody has marks. Why? Because the mark, and it's also explained by Schacht, is again under control of the central bank. Everybody who has a bill in his hand, a note in his hand, has to pay it back a few weeks later via some intermediation, but to the central bank, right? If not, it's enforceable. Repayment obligations, and therefore you cannot speculate against such a central bank. It's impossible. And they tried, but it failed 3 weeks later. Okay, and here is like it went on, and now comes the big problem. This is what so the mark from being, like this is the story from the beginning, you remember, we came back to that one. Like no treasury bills at all, no, like very enforceable short-term hard repayment obligations, like commercial bills, advances on collateral, little gold only, and before it was like that, treasury bills, worthless treasury bills, which became worthless step by step. Yeah, I have numbers to prove it. But these were replaced by Rentenmarks, which themselves were backed by this forced mortgage on landed properties. But the mark changed in a matter of days to a hard currency. From being that type of Argentine pesos everybody wants to get rid of as fast as possible, to being an accepted means of payment. It gained back its function as an accepted means of payment in a matter of days or weeks. And what happened? It was the central bank in the back, the Reichsbank, was recapitalized. And they could increase the money supply by a factor of over 15, because now it was again an accepted means of payment and a store of value. But what happened was at the asset side. And we have to understand, like, these recapitalizations, they're very difficult. Yeah, I just say, oh well, they fired 1/4 of the civil servants, 1/4, and preferably women back then, because for them it was easier, like, to survive. Could probably have a husband at home, but times changed, so be prepared. Like at the end, if you really go into that inflationary spiral, yeah, and when they understood, like in Germany, it was more or less at that point, in my interpretation, when they understood that they have no chance but to recapitalize the Reichsbank. Well, over here they realized, but they really knew, but you don't want to do it. It's because it's such a hard reform. If you did it over here, it wasn't that hard. At the end, it's very hard, right? You have some kind of a forced mortgage you need. You have to fire a huge part of the public employees. And at that point, with fiscal efforts which are reasonable, you still can do it. And that's the message for the euro area. We still can do it without a lot of... doing it right now, it's not as painful. It's not really painful. Okay. Let me make one more point. So why we don't understand? Because that is complicated. For other countries, it was much more complicated. In the case of the Reichsbank, actually, the assets were not that difficult to disentangle. But then the Reichsbank issued also Rentenmarks, for the Rentenbank. And you see, it's a very complicated matter at the end, the backing of all that liabilities, of all that money supply. There are other liabilities which you have to offset. I do that in my formulas, obviously, but you have to go to these books to get the entries, therefore the other simple story, it was all that money which created inflation on goods markets. It's much easier. Okay. December 23, sorry, I did not correct this slide. On the other slide, it was corrected. And all countries, they did exactly the same. In Hungary, they stabilized against the British pound, but anyway, they fixed the exchange rate, and in order to fix the exchange rate, you had to recapitalize the central bank, plus cut the monetary financing to the government, such that the central bank stays solvent enough to defend this exchange rate in the future. And, the League of Nations, if you really check their reports for Austria and Hungary, they controlled these and planned, supervised these stabilizations. They really understand what's going on. It's only we have to stabilize the exchange rate, therefore we have to, they don't use the term solvency, but therefore we have to recapitalize the central bank, and then they controlled each month the balance sheet of the central bank, right? And they did not care about the money supply increase. They knew that that's not a matter of concern. As long as the central bank is sufficiently solvent to stabilize the exchange rate, inflation is over. Okay, and econometrically, you can show it also for the other countries. Germany is an exception because there, you had this intermediate stabilization and huge central bank losses. You don't have for the other countries, and therefore you need a more detailed analysis. But if you do that, and believe me, I spoke to many econometricians. This, for example, is from bond prices. I also got over here, I call it the solvency factor, the deflating factor for that part in the balance sheet. How bad are these claims against the government? So let's check, for example, Germany, outbreak of World War I. I have the time series also in the appendix from outbreak of World War I. We are close to 1, but after the war, yes, you can see we are in trouble already. And then it became a little bit better after some reforms, but at the end, actually, the German bonds compared to very similar bonds on equivalent stock exchanges with similar maturities and so on, you can see that the German bonds were not worth anything compared to similar bonds, same currency, same stock exchange. And therefore, you can deflate the assets of the central bank. And by calculating, this is a simplified version, but by calculating in such a formula, which more or less tells you from all the money supply, all the demand deposits, included, the central bank money, let's say, if you discount the good claims, the net private sector claims, which at that time, today it's also different, but at that time where really were, the rules never changed. This one we can take one for one. They were secure claims, and here the government claims which changes with financial reforms in the back. Then the net international reserves, that solvency measure for the central bank, more or less, should explain the exchange rate. It explains the exchange rate approximately, rough measure, but approximately the exchange rate the central bank at that very point in time, at that month, could defend. Yeah? It's a solvency measure, not a liquidity measure. You don't have to be liquid in foreign reserves, you just have to have enough secure assets, which could be in domestic currency. And let me, this other balance sheet, like I was in Austria, I tried to tell you, this is the Austrian recapitalization via the League of Nations, and they were paid first in French francs, and then, what was it, Italian lira, I think. Well, you see, it's a lot of trouble, like to get this into this formula, right? To translate it into dollars, and you see it's a lot of trouble, but at the end, and also in Austria, when they founded a new central, then these sums were paid in. Here, like these, before it said like an asset when countersigned by the League of Nations, and then the capital flowed in. Well, but here you see also how in Austria it was recapitalized not only by the help from the League of Nations, but also they issued stocks, or they sold stocks, yeah, to investors. In Austria, like 50-something banks here who invested in the central bank. In order to raise they raised capital in that way. But let me go to the German time series, which I think is the best example. So the black line is the solvency of the central bank, the exchange rate which the central bank can defend, after subtracting or like setting off like all these different numbers from the balance sheet. And here, for example, you see the central bank losses we talked before. Like these are the losses logarithmic scale. So these are huge central bank losses. Yeah, the money supply, which increased with the outbreak of World War I, did not increase during that time. If you remember, like the older graph, the graph from before, you could see it easily. There I indexed it to the stabilization of the exchange rate, to that value for other reasons. But at that time, when the mark lost 90% of its value, no important money supply increases, but the assets just vanished. Yeah, they lost half of its gold, and which is included in the black line, but not in the money supply. And then the exchange rate and the price level follow suit. And here again, and as you see, this stabilization, it shows the central bank being solvent again. The money supply increased, increased 15-fold, but doesn't matter. The Reichsbank was solvent, able to defend the fixed exchange rate, which during normal times you don't even have to. But at that point in time, if you come out of that devaluation, permanently losing against the speculators, then at the beginning you have to defend the fixed exchange rate. That's how all hyperinflations came to an end. Okay, and if you do it correctly, then you will see also for the other countries where it's more not that clear, like just eyeballing it, as in the German case you cannot, but if you do it correctly, you will see that this relation which I told you, insolvency of the central bank, collapse of the exchange, price increases, recapitalization of the central bank, stabilization of the exchange rate, end of price increases. Fits much better the data than more money, more demand on goods markets, and then PPP for competitive reasons, like money not being valuable inside the country, then it should be also outside the country. The PPP relation is reversed. The causality is reversed. Okay, so I'm not going to talk about that. And actually, I think we cannot talk about the euro, but you get the main point. And it's all about the target imbalances and also what's happening right now with the euro system. we should monitor, let me show you one more slide. All the time we should monitor the assets, because if they depend on markets, right? The government bonds, for example. As long as these assets are valuable enough to hold back the liquidity, which increased sixfold, sevenfold in the euro area in the last 10 years, we are fine. No inflation. Or no, there is inflation for other reasons on goods and supply shortages and demand, but the real inflation, the heavy inflation, is not going to happen. If they become worthless, then we are in trouble. And the central bank already bought many of them in order to stabilize prices, but there is some kind of a tipping point, which we don't really know. They already bought more than a third. Yeah? I tell you, if they buy half or more than half, or like in Germany, the Reichsbank bought all of them, all of the short treasury bills, like the short-term debt, and it was completely worthless. Right? So we have to defend these assets. That's the main part. And actually, it's not that difficult because we have quite a solvent central bank still, or more or less solvent. We are not in Argentina. We are not in Turkey. We have a lot of gold, which is an equity position actually, because gold became much more valuable in the last decades, and we had this. Equity built up over here, the revaluation account. Let's just talk about this one. So that's, for example, very important here. Main refinancing operations, the euro system or the national central banks that issue the euro, they don't do any more main refinancing operations. They only do longer-term refinancing operations. But that is completely different from, it's much riskier. Yeah, main refinancing was like for a week. Yeah, backed by good collateral. But nothing can happen in a week. Now, only longer term, which means in the new central bank jargon, 3 years. Before it was 3 months. And to give you that number here, we don't know for that's also why I used the balance sheet from December 21. We don't know it for December 22. It's still not out. But here you see the relation, and that's concerning, right? If those banks now bank run, they get into trouble, the euro system is in trouble immediately. It don't even, it's in the balance sheet of the euro system already. They don't have this option like in normal times. No lender of last resort, no bailout. No, part of it's already in its balance sheet. Why? They lended for not very secure collateral up to 3 years. Okay, that's the last slide, the other one you can imagine. And this butterfly over here, we don't know what it's going to be. There was a butterfly, but Putin is still like causing a lot of frictions, let's say. Okay, thank you very much. Now we can make questions.
Okay, thank you very much for this very stimulating and thought-provoking talk. Unfortunately, we had to end on a more negative side, but now I would like to open the floor for questions. Please in the back here. And use the microphone, please.
So thank you very much for your very insightful talk. I found it tremendously interesting. I also follow Hans-Werner Sinn's work. So I have a couple of questions. If I understood this correctly, how far do you think are we away from a devastating banking run of investors out of the Eurozone? Do we potentially see sort of the pre-earthquakes right now? And then concerning recapitalization, how could we do this in practice with, do all the central banks do it on their own terms? Is there even the possibility for a European solution for this? Thank you.
Yes. So the first, it's recorded, right? The microphone. I don't have to
It's
repeat.
Recorded, yeah.
Yeah.
No,
Okay.
no,
So the first question, I don't really know. Like the commercial banks, and I think like even the experts who claim that they know how likely it is right now, the huge bank run, I have no clue. Yeah, if this is likely to happen, there are many risks outside, obviously, and now the interest rates increase is a huge problem because banking or the financial sector in general is lending long, borrowing short, and you have that liquidity risk, which can easily change to a solvency risk. We all know that the equity or the was not really increased sufficiently after the financial crisis, like this Basel weighted equity is not really like at the end it's the real equity, right? Not this weighted via the Basel legislation, and therefore there are many risks, but I don't know when this is going to happen, how this is going to happen. The central bank itself, it's easier. Like we know the numbers, we know the risks, and I don't think that we are in a very bad position. And I don't like, also, you mentioned Hans-Werner Sinn, like, which is, for me, like the last big German economist. But I don't like this notion of, well, they cannot do anything. We are trapped. We are completely trapped. Like the inflation brake, he says, is broken. The euro system cannot start to sell these securities because then Italy and Spain are going bankrupt and so forth. I think this approach doesn't lead anywhere because at the end, like in the governing council, they are better we just don't put harder requirements for collateral, or we don't better let's go on with our purchase programs such that Italy and Spain and Portugal don't get into trouble, and the asset prices, generally asset prices, not only the government bonds, collapse and so forth. No, I think like it's if you look historically, and also as I know the Argentine case very well, it's not that difficult right now. I don't really believe that it's difficult. First of all, we do have a huge equity position over here, which is in gold, which means it's like in foreign reserves, and also it's not all countries. Yeah, like probably if what we have to do, like the governing council deciding, okay, things have changed, no purchase programs anymore, and little by little, all these bonds, when they come due, not being rolled over, no new bonds bought, no TPI, like selling German bonds, buying Italian bonds, all of that comes to an end, which puts the European countries, mostly the southern European countries, under extreme pressure. If a haircut is needed, we get much closer to the solution to secure our currency. Yeah, even if Italy, let's say 20-30%, which is a huge haircut actually, yeah, needs a 30% haircut. Or Spain, let's say, or 20% haircut, we can manage it. Yeah, now some fiscal efforts to secure our currency. We are still fine. It's not. It's just we go into the wrong direction without knowing these risks, right? I think we easily can, or not easily. It's going to be a fiscal effort. And it includes many reforms, yeah, probably even in Germany, but it's far from impossible. And the earlier we do it, the better. Yeah, Every step we do in that direction, like buying more risky bonds over here or lending more long-term to these commercial banks, it's getting more difficult. And a financial crisis is not as bad as a high inflation scenario. It's much better. Financial crisis, we can handle. The inflation itself, and it has reinforcing effects, right? Now they can, the German government, we control these gas prices by additional debt, actually, and paying the difference, right? That's what they do. They just, with additional debt, they make for us and for our industry gas or electricity cheaper. But once you're in that, your central bank is insolvent already, once you're in that situation over here, it's flowing over already, the liquidity, to foreign exchange markets. And your central bank is already vulnerable on these foreign exchange markets. Then, if they take such a decision in order, because the authorities already always, like, they told their electorate that they will secure some low prices, for gas, electricity, and food and stuff. If then they take such a decision, we are in that spiral. It feeds inflation again, because at this one-to-one, more or less, the central bank is more insolvent, which causes more inflation. And history also tells us, for a few years, when they fight inflation on markets, on foreign exchange markets with capital controls or in goods markets, they need few years of failed policies to understand, no, the only solution, the only viable solution is to recapitalize the central bank, and still we can do it comparably easily. It's just the earlier we do it, the better, And I don't like this notion, no, we can, it's broken, no. Okay. It's not such a big.
Another question here, I think.
Thank you very much for your presentation. I was wondering if you could shortly explain why the inflation rate in Austria is higher than in comparison to other European Union countries.
Whoa, how high is it in Austria? I don't even know for Austria exactly the.
I don't know the exact number.
But it feels very expensive. Yeah. This is the only one left. I like to show it with a bigger note, but oh my goodness, very expensive over here. So the main, between the European countries, it's like internal problems. How bad are these supply shortages? And the supply shortages can happen on the labor market, like after Corona, people who left their workplace and don't come back. And this is very diverse. But let's say between the European countries and the Euro area countries and the other European countries who don't have the euro as a currency, if you look at your neighbor country in Switzerland, inflation was what? When we had 10%, in Germany they had 3.5%, and that is part of it already was, now we are again catching up a little bit to the dollar, but before the euro was on its lowest exchange rate for the last 10 years or something. So it also has an effect, right, for all these imports where we have to pay in dollars. So a little bit of that happened already, but only we're still fine. This picture is much more dramatic. So for Austria, I don't really know. I don't know. Sorry. Yeah. Ask me about Austria in the 1920s, I can tell you, but it feels very expensive. Yes?
First question, second question. The first, Jona?
Yeah, thank you very much as well. My question is kind of a clarifying one, and I want to ask this connection between state insolvency and central bank insolvency. And the examples that you mentioned in Argentina and also the ones in the 20th century, it always seemed to be the case that the first estate was insolvent, and then the central bank got insolvent as well, because there were a lot of treasury, a lot of bonds basically on the balance sheet. Is this always necessarily the case? Because I think you hint that it's not, right? That the central bank can go insolvent first. And like according to my intuition, I think, doesn't it always have to happen at the same time? Because as long as the state is not insolvent, theoretically it can always issue more bonds as long as there's trust in the state and can back up the central bank, no?
Yeah, monetary financing, at first to more or less still solvent government, and then little by little they lose solvency for whatever reason, a lost war, and then it happened. So in Argentina in 2001, when they first default, and you had this crisis, the central bank being in that currency board, they issued dollar-denominated bonds, like the sovereign, right? And these were bought by the central bank, which is, you cannot, and if they devalue, then you cannot keep the currency board. So they had to devalue the peso. They had to leave the currency board in that moment. And obviously, most of the time, it's always like it's the central bank is meant to be a banker's bank, but it's obviously like the bank of the government for whatever reason, pandemic, war, other problems, yeah, and it happens little by little that like central banks become insolvent because the government gets insolvent and more borrows from the central bank. That's like all the cases I know, somehow it's in there. But additionally, you have central bank losses, like I showed for the German case. Yeah, at first you cannot explain the German inflation, and the mark collapsed to 10% of its post-war value in a matter of a year and a half. Central bank losses. Yeah, it was not the government insolvency at that point in time, and afterwards, why Germany is also a nice example, the government can still be completely insolvent. You can recapitalize the central bank. Yeah. Not that easily, right? For example, right now it would be much easier. We don't really have to recapitalize it. We just have to capitalize it. Yeah, like ending these decapitalizing rules we have in place right now. And yeah, most of the time, obviously, it's highly connected. But at the end, with the recapitalization, it wasn't. You can see it clearly in Germany. In the other countries, there is some link afterwards as well. But yeah, it's still like to really understand the mechanism. Therefore, for example, I mentioned the lending to the commercial banks. It makes a huge difference what collateral it is, and it makes a huge difference if you lend for a week or 3 years. Yeah. It's completely different for the stability of our currency. And this one is not really connected to the government, for example. So most of it is part of the picture, but not always. And it's not the complete picture. Okay?
The gentleman here.
You say that the central banks have to be recapitalized immediately.
Immediately.
But I think they are all capitalized 100%. The only problem is that the value of the assets is not corresponding to the figure of 100%. As you quite rightly, here, let it. Yes, as you show here, and this one,
yeah,
it is 100%.
Yes.
Only one can read in newspapers, Portuguese bonds, I have nothing against Portugal, I only quote what I read in the newspapers, are valueless. Some Italian assets or bonds are valueless.
Okay.
So my question is, what would be your guess? when you would correctly, like it would be the case with enterprises, if you would correctly evaluate these assets, would you say then that the European Central Bank has assets which are in reality valid 50% of what they say, or 80 or 20?
Yeah.
Because this is a decisive figure.
Okay.
They are 100%. And one again, with regard to what you have just discussed, states and central banks. Naturally, if a state doesn't get any more money from the central bank, it's bankrupt. If the United States now, if the debt ceiling is not increased, United States is bankrupt, because then the Fed is forbidden to give finance treasury bonds of the United States. So I think it's most of the time at least, the state which is first bankrupt, and the central bank says, oh, so sorry, we can't give you any money anymore. And then the sequence follows. We will see how it works out in the United States. Naturally, at midnight, they will increase the level and so on. But this is a sequence. But my question is, how would you guess the percentage? 50%, 30, 80?
Okay, the United States, that's the matter of parliament. It's not a market-forced default. So if they want, or they decide, then they can issue. So the markets are not, okay. But again, like these numbers, they're more or less correct. So the newspaper saying that Portuguese bonds are worthless, no, because the market share from the euro system itself is like a third only. Most of the bonds are still held by private investors. And these private investors, well, there are very strange incentives. I mentioned the Basel regulation that if you hold government bonds, you're somehow in a better position. You have to hold less equity. But anyway, more or less, it's still a market value. And the central banks buy bonds on the secondary market. It's completely different from the 1920s, and it's completely different from Argentina, because they are officially, probably they do, but it's more or less like a direct financing. It's the central bank giving credit directly to the finance ministry. Here they buy it on the secondary market, and now with the percentage increasing, like 1/3 is concerning, and we get closer to 1/2, which is very concerning. And as you mentioned, we don't trust the Italian and the Portuguese numbers that much anymore, because let me come here. Right here, the investors, that's an example from Twitter, the investors, they check not for the overall holdings of the euro system, but for the newly issued bonds, right? And here you see Italy, so it was last year, actually the Bank of Italy, the Italian central bank, being the market maker, buying almost all the bonds. From the new issues, right? And there we can start to argue, well, this is not a market result anymore. So, but it's not like 100% away. Probably these are overvalued by the euro system being such a strong market maker for Italian and Portuguese bonds. But let's say it's 10, 20%, the buyers. It's difficult to measure, right? And the euro system as a whole, most of the bonds, they're not from crisis country, less than half. And the other bonds, and even those ones, like they're not, 50% is an enormous haircut. So let's say 10, 20%, that would be probably the right price. When the ECB or the euro system stops to being a market maker for these bonds, I said maybe we need a haircut, yeah? Fiscal reforms, for sure, in these countries, which are not able to issue for low interest rates or roll over their debt, yeah, and that's disciplining part, like the high interest rates, and there is crisis and fiscal reforms needed, and probably there is also a haircut, but not more than 50%. I don't believe that, because also that's another issue. Look at we have time, and with inflation, already these bonds some of them kind of devalued. So that's the maturity extension after 2010. And Austria, look at Austria. You issued a bond like a 100-year bond over here. So you extended your maturity incredibly to an average of your sovereign bonds from close to 12 years. But if you look the countries, for example, Italy over here, which is circled in red, we have time. So if Italy cannot roll over its debt for affordable interest rates, but only to higher interest rates, well, it's only like 1/7 it has to roll over in a year. And this also tells us that whenever we experience, because many things happen at the same time, and whenever we experience a wave, an inflationary wave, probably because our central banks already become vulnerable on foreign exchange markets, our debt is also devalued. So there are many things in between. The gold becomes more valuable inside the balance sheet. That's also kind of a backstop for these inflations. And so there are internal problems, like I talked about, these tipping points and the political logic, and the politicians making a lot of mistakes probably because we are going to that blind alley, not really understanding the political mistakes during hyperinflations or during strong inflation, but other things like natural backstops, for example, that gold position over here. So I think doing the accounting for and there is obviously I tried to do that in another paper. I called it the permanent stress test, or defending the euro from inside out, a permanent stress test of the ECB balance sheet. And they are to calculate the real value, because they give you the historical value. They changed that in 2010, I think, with the accounting rules with the problem of the S&P, and to get the real value. But it's not like you said at the beginning. They're not worth anything. They are probably, it's slightly biased, the market prices for some bonds, yeah, but not that much. I think we can still with some reasonable fiscal effort, we can still solve the problem, and we have to. It's just getting worse every year. Yeah.
Okay, so I would say, for the sake of time, this was the last question. I hope that you are still available to chat a little bit with also the students. I would like to thank you for being here, and I would especially like to thank you for giving.
Yeah, thanks for having me.